Hello and welcome to the Business Standard Morning Show. This is Thirumoy Banerjee and here's a look at the top stories for the day. At a time when global tech giants like Google, Microsoft and Meta are on a firing spree, Indian IT major TCS has said that it will not hand out pink slips to its workers. Rather, it has announced to hire from the talented pool, which has been laid off by Indian startups and US tech companies. So why is TCS bucking the trend? Bhashwar Kumar's report has the answer.
By the end of January, close to 80,000 Indian IT professionals were without jobs in the US. For them, it's a race against time now. They have to find new employment within the stipulated period under their H-1B and L-1 visas in order to stay in that country. The situation is grim back home too. Wipro laid off 452 freshers in January after they performed poorly in internal tests, followed by Infosys, which also fired 600 freshers in February on similar grounds. This was followed by Google, which handed over pink slips to 450 employees across various departments in India. Since the beginning of this year, about 380 tech companies have expelled over 1 lakh employees worldwide. Of these, nearly 35,000 layoffs have been done by India-headquartered firms. While February saw layoffs at Yahoo, Byju's, GoDaddy, Autodesk, OLX Group, GitHub and eBay, the likes of Amazon, Microsoft, Google and Salesforce accounted for most of the pink slips in January. This is what data from layoff.fyi, a website that tracks job cuts globally, showed. However, it seems some are bucking the trend. Indian IT major TCS is one of them. On February 19th, the Chief Human Resources Officers of Tata Consultancy Services, Milind Lakkad, told a news agency that the company was not considering any layoffs because it believes in grooming talent for longer careers. On the contrary, Lakkad said that TCS would hire startup employees who had lost their jobs, especially from the edtech sector. TCS is the country's largest IT firm, which employs over 6 lakh people. So how is TCS able to swim against the tide? The answer lies in Lakkad's statement. He said that many companies were being forced to fire staff because they had previously hired beyond their requirements. He said that TCS was cautious and believed that it was the company's responsibility to make an employee productive once he or she has been hired. In 2020 and 2021, the pandemic-induced enthusiasm around digitization and technology drove companies into a hiring spree. According to Kotak Institutional Research, top 6 IT services firms witnessed net headcount additions of more than 86,000 in the September quarter of 2021. This was the highest pace of quarterly additions in 8 years. It was also 4 times higher than the 19,000 additions in the same quarter of 2020. Startups too went on a hiring spree, only to run out of funding steam later. Things changed towards the middle of the calendar year 2022, and the headwinds have only intensified in 2023. There are recessionary concerns in major Western economies, which are a significant source for both the Indian IT sector's revenues and the startup sector's funding. The easy money era, which tech companies across the globe took advantage of, has also come to an end. Meanwhile, for TCS, the decision to hold off on job cuts comes after it beat revenue expectations in the third quarter of FY23. However, it missed the mark on profit estimates. The management had also issued a positive demand commentary. At that time, Motilal Oswal had said that while reduced demand visibility remained a key risk for FY24 growth, TCS was well positioned to withstand the weakening macro environment given its order book and exposure to long duration orders. Agile hiring plans may be another reason TCS can do without layoffs for now. And Indian IT firms have relatively more lead time than their global peers when it comes to adapting to developments, since the former maintain a bench. TCS saw a decline of over 2,000 staffers in overall employee count in the December quarter of FY23, and the global HR head Lakkad did not specify if the March quarter would see an addition or continue with a decline. He said that across 2022, TCS had hired over 2 lakh employees, including 1,19,000 trainees who were still getting into billable projects. He added that the resulting slowdown in new hiring had led to the decline. He also said that TCS would not see significant additions from a net employee standpoint over the coming few quarters, as it would be leveraging its past investments. So, what do experts have to say about TCS bucking the trend on layoffs?
Number one, Tata Group as such has got very strong ethos and values, and they definitely, I think, as compared to any other organization I've seen, I think they are the most pro-employee organization. Second is TCS is one of the most profitable IT company I've seen. It means that you've got more power to absorb such short-term aberrations what you see. And third and foremost is, I think companies like TCS in the past have gained a lot with their bench strength. Normally, when suddenly businesses come, bench strength comes highly useful. Even, to take care of your attritions. Also, when you get new assignments, new countries, new projects, I think you can very easily and quickly encash on that.
Mostly the technology companies are in the process of laying off because the roadmap or the strategy that they have adopted so far needs certain modifications. But as far as IT services companies are there, they have a very good pipeline at this point in time, and that is why they are less bothered about the impacts of recession or any other impacts we are talking about. In fact, they are upbeat that probably that will come with some sort of opportunities for them. While said so, there are some smaller companies who have got point solutions may get impacted because of certain changes which are there and the cascading impact of those changes. But I don't see that there is a immediate threat of any layoffs.
As the year progresses, TCS may not be the only Indian IT major to buck the layoffs trend. In fact, the early job cuts at Wipro and Infosys notwithstanding, IT and tech sector analysts expect recruitment to pick up after a few muted months, especially on the back of the 5G rollout. This may also prompt these firms to increase their bench strength instead of laying off staff, since they will save on the cost of training new employees once these opportunities present themselves.
TCS has certainly set the bar high. Its decisions have provided plenty of food for thought to other companies. Speaking of food, ancient Ayurveda believed that cure of most ailments can be found in our kitchens, and a healthy diet keeps all the ailments at bay. But are we eating healthy? Do we get all our essential nutrients from staple grains like wheat and rice? Or do we need the forgotten superfoods like millets, which have been making a comeback of late? And what are the challenges that these coarse grains are facing to become a visible alternative to wheat and rice? Tariq Ahmed brings all the answers.
According to a recent study published by UNICEF, over 80% of adolescents in India suffer from hidden hunger. It is a deficiency of micronutrients that affects health and learning ability. So, what can be done to overcome this nutritional deficiency? Do we have an alternative to wheat and rice? The answer is yes. And decision makers in India have been trying to bring back that super crop of the year back on the people's platter. Millets slowly faded into sunset over the last 70 years or so. The Green Revolution, which gave a fillip to wheat and rice production, expedited the millet's departure from people's diet. Elderly still know about the health benefits of coarse cereals, and millets, it seems, are making a comeback, thanks to the increased awareness about its health and environmental benefits. Climate change, need for sustainable agriculture practices, and quest for more nutritious food have brought attention back to millets. The United Nations too has declared the year 2023 as the International Year of the Millet, after a proposal by India. Over the years, several state governments have introduced millets into the PDS also. Several FMCG companies are also turning to millets for biscuits and breakfast products. But the prices are a big challenge. So, why are millets expensive? And what can be done to bring it down?
It takes a lot more resource to grow rice than millets. But why is millets much more expensive than rice? So because we have been working with millets since 2017, 2018, and this thought was always interesting to me. See, what happened is, again, main reason goes to Green Revolution, where rice cultivators are heavily subsidized. For example, the place where when you go to Andhra Belt, there are a lot of rice paddy production, and rice mills are just located next to the paddy fields. Whereas when you look at millets, right, millet grows different areas, and on an average, when we did our research in 2018, right, 100 to 150 kilometers is the minimum distance that the cultivator has to take these millets and process them. So a lot of technical challenges are also there.
Meanwhile, FMCG companies too are doing their part to popularize millet. Several millet-based products have started to appear on the consumer market lately, like multigrain bread, nutri-cereal biscuits, multi-muesli, vermicelli, noodles, etc. The range of these products are increasing and new brands are mushrooming. India's biggest consumer food manufacturers have ambitious plans to produce millet-based packaged foods. ITC, HUL, Britannia, Nestle, Tata, and several other startups are expanding their millet-based portfolio. Britannia, under the flagship brand called NutriChoice, and HUL under the Horlicks brand, have plans to bring more millets into the consumer products. Nestle and HUL have tied up with the Indian Institute of Research Center to develop more nutri-cereal-based food products. There are different kinds of value-added food products that are made out of millets, and a lot of research is also going on in this space.
And there are a lot of value-added products where millet cookies are popular, vermicellis are there, and it being used or with roti is also happening. For example, we are always fascinated with millets. So last couple of years, we did a lot of R&D. Right now, we're in the midst of launching millet milk. So we're making milk out of millet.
The higher prices remain the biggest challenge for the millet-based products to achieve a wide consumer base. The cause for the higher price is the lack of supply.
The supply side is 40% negatively skewed. So if demand is 100, we are able to supply only 60%. So 40% is not there because the things which were cultivated earlier are not cultivated today because there are no markets and you should find a market. So 5 pronged strategies happened. One is creating a market. How do we do that? So that is where the industry came into picture, whether it is Hindustan Unilever, Britannia, Nestle, and the startup ecosystem that was developed very recently. It all has created a bigger canvas of traditional, modern, and ready to eat, ready to cook kind of food products which you generally see with rice and wheat.
So, the market that is going to be created by the bigger players will definitely enhance the production levels. This way, the supply and demand balance will be reached, So the price for millet-based products will come down to create a large consumer base.
Now, with all the market created, farmer would be convinced that I have a market, I can sell my product anywhere. I have machinery, I can process it, there is no difficulty today. So this thing will attract the farmer to cultivate more, expand the area. Then as the research institutes and all other people teach them good agricultural practices, you have better quality grains, both for domestic use, which is enhanced. When it is enhanced, then the prices would come down. Then anything surplus remaining, then it goes to the export.
India is the largest producer of millets. In 2020, India produced 41% of the total millets produced globally. In a written reply, the Union Minister of Consumer Affairs estimated that India will be producing 205 lakh tons of millets in 2023-24. According to experts, higher prices prevented millets from attaining a wide consumer base. But as the big consumer food products manufacturers build their millet-based food portfolios, the cultivation will increase. Also, the government's mission-driven approach will help the millets and value-added products to crack the consumer market, even to a level that makes India a major exporter of millet-based products.
Let us turn our focus back to the issue of hiring in IT firms. The IT index has been an outperformer so far in calendar year 2023, even as IT companies have been trading cautiously on hiring fresh talent. So, what is driving the stock performance, and should you buy any given the overall macro setup? Find out in our next report by Puneet Wadhwa. Global tech majors such as Facebook, Google, and Apple are in the process of pruning their workforce. Twitter, too, has shut 2 of its 3 offices in India. Back home, IT sector bellwether Infosys and Wipro too are going slow on hiring and have delayed their visits to campuses. The story at the bosses, however, is playing out differently. The Nifty IT index has been the best performer with a rise of around 10% thus far in the calendar year 2023 as compared to the Nifty 50 index, which is down around 0.5% during this period. Among stocks, Persistent Systems has rallied around 28% so far in 2023, while TCS hit an over 7-month high last week as investors turned to defensive plays in a volatile market. Analysts say the upmove follows firm Q3 results from the sector, which have prompted investors to relook at the stocks.
I don't think so. See, in terms of the post-quarter Q3 numbers, the pattern given by the management was absolutely clear in terms of hiring new talent with respect to the demand and supply kind of a scenario. I am quite optimistic in terms of, basically IT industry is all about utilization of gray cells, that is brains, and how innovative contribution can employees give to the organization. A lot of people had stayed away from it. Third quarter, they have totally changed in terms of how to approach IT sector. We as a brokerage house remain positive. My only sense is that they may go slow for some short to medium term period of time, given the kind of environmental backdrop which IT sector is emerging from. So as and when the opportunity arises and they have to hire, they will do the needful. And possibly in terms of quarterly numbers, I think since we've seen a stable third quarter number, fourth quarter should be a little bit better. Next financial year onwards, that is 1st April onwards, I think there should be better times for IT.
Meanwhile, according to HSBC, earnings forecasts for S&P 500 companies in the US have plateaued or declined for almost a year now across most sectors. The worst impacted include consumer discretionary and high-tech. This does not bode well for tech budgets in 2023, it believes. As we further analyze business commentary from top customers from key sectors such as banking, telecom, retail and high-tech, the outlook for 2023 tech budget growth ranges from flat to slightly positive. We believe this will impact IT companies over the next few quarters. Back home, G. Chokkalingam, founder and CIO at Economics Research, expects IT companies to pass on the rise in employee costs to end customers, while rupee depreciation will be beneficial for the firms, he says. IT stocks had corrected sharply before the start of 2023 and valuations had become attractive. There is room for more upside in select counters, but investors need to be selective. We are bullish on Oracle Financial Services Software, Cyient, Zensar Technologies, Susken Technologies and Wipro, says Chokkalingam of Economics Research. Broadly, investors should be selective as regards the IT sector and buy where there is earnings visibility, at least for the next 2 to 3 quarters. On Tuesday, the markets could remain range-bound amid stock-specific action. An equity research report by Jefferies recently said that Adani Group's consolidated net debt is at 2 trillion rupees and it has relatively low refinancing needs in the near term. The report comes after some banks showed reluctance in refinancing the debts of the Apple to Airport Group. But what exactly is debt refinancing? And how is it different from debt restructuring? We decode it for you.
In a bid to instill some confidence in investors, Adani Group recently announced that it will prepay some of the debts. One of the accusations leveled by short seller Hindenburg against the Apple to Port Group was that it was deeply over-leveraged. The group also said on February 15 that it saw no material refinancing risk amid reports that some banks were reluctant to refinance the debt taken by India's fourth largest conglomerate in terms of market value. But what exactly is debt refinancing? Debt refinancing means that you are replacing one loan with another. And why do businesses and people do that? They do it to get some favorable results. The most common motivation for opting for refinancing is the drop in interest rates. If you have taken a loan at 8% interest and the government slices it to 6%, you will be interested in debt refinancing. On the other hand, when a company is expecting a large cash inflow, they will do refinancing as they can decrease the total interest rate payment. Companies will capitalize the increased creditworthiness when they are having huge cash inflows to lower the interest rates by refinancing. Though refinancing sounds somewhat similar to restructuring of debt, in reality both are very different. Restructuring of debt is done when the borrower is in such a financial position that it prevents the timely repayment of loan. But in refinancing, the borrower will obtain a new loan with better terms to pay a previous loan. Companies also achieve this through issuing callable bonds in lower interest rates. Callable bonds are the kind of bonds that the issuer can return the principal to the investor and stop paying the interest rates before the bond reaches maturity date. The most effective way to refinance the debt of a company is through issuing equity. This can be extremely beneficial when the company's stocks are trading for high prices. In Adani Group's case, cancelling of FPO prevented them from refinancing debt through issuing equity.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
On Monday, Adani Group's market capitalization slipped below $100 billion. It was a steep $135 billion drop since the release of short seller Hindenburg research report. That's all for today. For more news and analysis, please log in to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.